Listeners, welcome to the source of commercial real estate. I promise we're going to talk about real estate today. We talk to the experts here in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial properties. And today I'm talking with Austin Hare. He's a real estate investor. He specializes in the site selection for healthcare groups. And he helps his clients as well as his investors maximize. We just talked about his experience in American Ninja Warrior. He also has a background in professional wakeboarding, which he touched on. And today we're going to be talking about retail and healthcare and how to invest in that. Austin, thank you so much for joining me today. How are you?
Yeah, thanks for having me, Jonathan. I'm excited to talk shop with you.
Why don't we start out by you telling us a little bit more about your background and what your work looks like today?
Yeah, my background, mentioned it, was wakeboarding, and then we started doing ninja. We've always been into health and fitness, so I actually opened up some gyms for a while, and that's when I got into the site selection component. So I was opening up fitness centers in Orlando, and I met my partner, and he ran a demographic analysis and a competition analysis. And what I found was the areas that I wanted to go to were really saturated, really high rents, lots of competition, and the areas that I didn't want to go to, that I wanted to stay away from, were actually wide open. So I was impressed with this process. I sold the gyms in 2019, right before COVID, so dodged that bullet. And he invited me to start working with him full-time on commercial real estate. So I said, yeah. So we were working together both in the site selection and in the development side. And really, the site selection is like a net that we cast, like a really wide net, in order to get good development deals. Would that have good returns?
Take me back to 2013. I heard the story about you trying to open one of your gyms and you got hosed on the location. And that may have been the impetus for you getting interested in this idea of site selection. I think it was a failure, but tell us about that experience and choosing the wrong location for that property.
Yeah, so it's an interesting story. If any of your listeners are familiar with Alex Hormozy, I was actually introduced to him really early on early in his career through this whole thing. Anyways, in 2013, that's when we opened up the first location. We did one that was convenient. It was close to my house. That one actually ended up being a really good location. And then I thought I knew everything, right? I thought I was this great business mogul and I could find the best sites. So the next one I picked on my own, and I acquired a location from another guy, and both those locations were actually really bad. And so it was through my own hubris that I looked specifically at income demographics. I did not look at population density at all for the second location, and we really struggled. And then same thing with the one that I acquired. It was just in a bad location. I got it almost for free because the guy was struggling. And I got lucky that I got introduced to Alex Hormozy. We did the program called Gym Launch. It worked phenomenally well. And we totally turned around the underperforming gyms, and also the one that I had started doing much, much better. And so it was like that time when I was looking to do my fourth location that I realized, okay, I don't really know a lot about the site selection as much as I thought I did. So that's when I started working with my partner. We got connected through a mutual friend, and I was really excited to hear that he has an analysis. And so it was, the first location was good. That gave me false confidence. I almost had to go out of business. Luckily, I met Alex Hormozy. We turned those around. And then I met my partner, who helped me get really granular on the site selection process. And to be specific, what we do is what he did for me, and now what we do for specifically healthcare and retail groups, is it's an overlay of the grocer anchors in the area to find out, okay, who are your ideal customers, patients, etc., where they are going. And then it's an overlay of the competition. Okay, how do we get the most amount of ideal patients with the least amount of competition? That's really its simplest form. And so, learning that process, I actually ended up, I told you a second ago, selling the gyms in 2019. Nothing to do with good timing or anything like that. It's just the fact that it was a franchise. I had got in a big disagreement with the franchisor. We did not get along. He made it illegal or whatever. He made it so that we were no longer allowed to work with Alex or Gym Launch. So he said, hey, I'm not getting a piece of this. You guys aren't paying me to work with Alex. I don't get a cut. So therefore, nobody can work with Alex. And so I saw the writing on the wall. So I listed him for sale, and I got out. I don't know. Is that it's a long-winded answer to your question.
So tell me about that first location. You said that it was a terrible location. So looking back on it now, 10 plus years later, what made that location terrible?
Yeah, and sorry, maybe I wasn't clear earlier. The first location was good. It was the second one and the third one that were not good. So what made those two not good specifically was the population densities. So we were looking at the income demographics, and we saw they were high income demographics, but we didn't do the math and say, okay, if you just multiply the income demographics by the population density, you can find areas that are like lower, quote unquote, lower income demographics, but the population is so dense that you actually have more wealthy people, right? That was just a thought that never went through my head. So there's a couple things. Number one, the anchor tenants were not a lot of great synergy. It was next to a Home Depot. So we thought it'd be really busy. It's not really like your exact avatar. And then the area was just not as crowded. And then same thing, the third location, not a great location. It was actually in Publix, which is great, but it was across from Universal. So a lot of transient population. And the people who lived there were a lot of the people who worked at the parks. And so not really like an upper income demographic that's going to be paying for like these personal training services. The first location was it was right near downtown. The rent base was not bad at the time. We got in early, and just the sheer population density made it work out, you know.
And so 2019, you sell the gyms, and I assume that's the time that you transition into healthcare. Talk about what caused you to get into healthcare real estate.
Yeah, so it was my partner, the guy who brokered for me. He had been focusing on urgent cares and health cares for, at the time, like 10 years, and now it's been another 5. So that was like 15 years that he's been doing this. And he just had a good background in it. And we came together and we're like, hey, what asset class specifically do we want to focus on? And so we looked at real estate, and it was like at the time it was recession resistant. Now it's recession resistant, pandemic resistant, inflation resistant. Healthcare is just a super, super safe asset class. According to the SBA, like dental has the lowest default rate among all of the different sectors that they track. And 2019 was 11 years after the great financial crisis. And we're trying to really hedge our bets and pick what we think is the smartest or the safest option. And so he had been doing urgent cares. It was a little bit more of a blue ocean, because another thing, in addition to the safety, is that it's a little bit more niche, meaning like for a developer, if you want to go after a 7-Eleven, they got a lot of people approaching them for deals all the time. If you want to go after a good healthcare group, it's almost just as safe, and they have a lot less people approaching them. So it's a little bit more of a blue ocean, and that's how we landed on that.
All right, now we're in 2024. Tell me about typical deals that you're doing today. What are you after?
So we focus on like retail healthcare. We call it multi-site healthcare groups. That we do a bit in dental. We also do some dermatology, some vet, behavioral health, urgent cares. So anything like sub 10,000 square feet is our wheelhouse. And so the way that it works, like one of the interesting things about healthcare is that even though there's a growing population, or I should say patient population, they are a little bit bottlenecked and capped at their income. So healthcare has grown the spending of healthcare has gone from 350 billion in 1987 to $3 trillion as of today. Like, it's just been an insane path to growth, and it's not slowing down anytime soon. The only problem is that when it comes to reimbursements, a lot of healthcare operators are capped by either the insurance companies, or if they're taking Medicare and Medicaid, by the government. And so you have the situation where costs are rising, but income is capped and their margins are getting squeezed. And because there is a growing patient population, there's not a lot of second generation spaces available. And so what that means is, if you want a new space, because you're growing, you have to go develop it. The problem right now is just inflation, rents, land, interest rates, labor, materials, all that stuff is just really expensive. And when you're dealing with capped revenue, it's very difficult to go and pay these numbers. So what's the solution? It's, in our situation, how we've been overcoming this is using our relationships that we've been building with the multinational tenant retailers for the past 15 years. In addition to doing urgent cares and different healthcare groups, we've also been building relationships with Starbucks and Panda Express and Chipotle and AutoZone and stuff like that. And so what happens is, a lot of developers, if you get an assignment, it's very common for, let's just say, a dental group wants you to go and build them 2,000 square feet. Okay, great. That's easy. No risk. I got my tenant. Boom, I'm done. That's a no-brainer. The cost is the most expensive per square foot to do a single freestanding building. In order to get the economies of scale, you really want to do 2 or 3 tenants in a situation like that, where you want to max out the amount of square footage you can fit on the land that you have, which is usually like 8 to 10,000 square feet per acre. And if you don't have great relationships with other tenants, or especially national tenants, then you're just taking on a lot of risk. And so the way that we overcome that is by just leveraging, because we built relationships all around the country by working with these healthcare groups all around the country. And so we have networks of these retailers that I mentioned that we've done deals with. So for us, it's a little bit safer to take on a multi-tenant deal because we can tap into our network that we know. So as a result, we overcome this problem of being too expensive for healthcare users by bringing in these retailers to pay the retail rent. Healthcare users can get a little bit of a discount and investors still make a great return.
So I'm picturing, you mentioned these national retailers, and I'm like, okay, where is he going with this? Incorporating these medical providers with AutoZone and Starbucks. Is this where you might see a 3-tenant out parcel or something like that with Starbucks and an Aspen Dental together? Is that the kind of stuff that you're working on?
Exactly. Yeah, that's a great example. I was going to bring them up. Yeah, so Aspen is exactly, they paved the model, to be honest. They paved the way. But we don't work with them specifically because they buy all their own real estate. So they're just not bringing on new people to work with. They buy in-house everything and develop it. They actually opened up their own urgent care sector. They acquired an urgent care company because they're already taking down good real estate. And so they just thought, okay, like we're going to buy this building. We might as well put in a great urgent care right next to the dental place. And then maybe we'll have a third retail space. And to your point about Starbucks, yeah, they love going right next to Starbucks. Like that's perfect because it's like the same type of clientele is going to be a private pay customer for them or patient for them. Yeah, that is. So for anybody listening, if you can visualize one of those, yeah, that's essentially exactly what we're doing, but it's open. Open is maybe not the right word, but they're just private and doing everything in-house. So
talk about the evolution of these medical providers turning into more Medtail, because 20 years ago, you wanted to go to a dentist. You went to a 70s or 80s era drab medical office building, and you went to the dentist or the orthodontist in one of those buildings. And now you're seeing more of these dentists and massage therapists and orthodontists, urgent cares in strip centers next to Starbucks or next to a grocery store. Can you talk about maybe bring in your expertise in site selection? Why the evolution in the medical model this way?
To start high level, I think that over time, everything just gets more customer centric in every industry. And so if we just look at how Amazon has made it so easy and so convenient for the customer, one click, free shipping, it's just easier and easier. And so by the same token, you're trying to make it as easy as you possibly can for the consumer, right? If they have to, even if it's only a block down the road, if they have to drive and get off the main drag, it's just not only is it less convenient, but it's also, they're not going to be seeing it as much. So it's those two things in at the same time. We call it drive to, not drive through. So it's grocery stores are great anchor tenants because the average family goes there 2.3 times a week. Really though, this all started back in the 50s with the fast food joints. Now we call them QSRs or quick service restaurants, but they started taking up really good real estate on the corner of Main and Main. It did really well. And then you had different sort of industries following them. Big banks came next. They saw how well these guys were doing and they started getting some of the best real estate. After that was like the CVSs and the pharmacies, and then urgent cares you see them on the Main and Main. And so now Tony Robbins is saying success leaves clues. And dental support organizations or DSOs, those are the multi-site dental groups. The best ones are paved the way by getting this grade A retail like Aspen Dental. And as a result of them, they have become almost like a household name. And so the reason is just because the convenience for the customer, and then when they're driving by, they're seeing that over and over again. What we like to say is that you should view rent as a factor of marketing, meaning you can go recessed in these back areas. You can absolutely pay for direct mailers or digital marketing or Google ads, but those are bidding platforms. They're auction. And so over time, they're only going to go up. And so it's just like the combination of the customer seeing you over and over again, and then having that convenience of not having to go out of their way. That's where the future is going. That's what we help coach people through. That's how we run our analytics. But yeah, it's stacking the deck in your favor is the goal.
I imagine everyone would love to be the out parcel to a grocery store next to a Starbucks. That's the ideal spot to be. But I imagine those spots are hard to come by. They're expensive, and not everyone can afford to go there. So what other factors do you consider if you're talking to a dental group or somebody else who says, yeah, we want to expand, help us choose the right site? What other kinds of sites are you considering?
Yes, the answer, the Publix, shopping centers, large shopping centers, all these giant places, they do fill up really fast. And then like even places like Heartland Dental, which is another large DSO, a lot of times they have people working with these developers for the shopping centers. And so they get like the first right of refusal. As soon as the ground is under a contract, like they're going to these guys, these big DSOs, and they're offering them this space there. So it usually gets filled up a lot. And then of course they're going to have an exclusivity clause. So you're not going to be able to put a dentist right in that plaza unless they go out of business or they relocate and you take it over. So really what we try and do is like, how do we piggyback off of that traffic, the foot counts, the publicity, like all the people that are going there. And so we'll look for spaces. If we identify an area where there might be two grocery stores in the same corner, right? So if they're on the northeast and the southwest corner, maybe we'll go to the northwest corner where it's across the street from the Aspen or the Heartland or one of these big DSOs, or even just another dental group. And especially like if there's a situation where we can get closer to the road, because sometimes in the big grocery anchors, you might be sitting way back and covered by trees and you can't see you. So there is sometimes a possibility of outpositioning the competition if you can piggyback off of the exposure or the foot traffic or the drive traffic to the grocery anchors, and you just go to a place that's really close by, that's right off the main drag. And another thing too, asking about cheaper rent, not everybody has to go retail. We try and look at everything situationally. We stay away from the medical condos personally, especially if they're on second stories or third stories and you're buying just an individual office. Like those, it's hard to see a long-term future in our opinion. Not saying they'll go out of business, just it's not really our wheelhouse. But like just because it's medical doesn't mean it's a no-go. So like sometimes people will take offices that are a couple roads back because it's a great deal. And then you can put that money into marketing to make up for that. Or sometimes it's a group that doesn't necessarily need direct retail. So like sometimes we work with specialties that are referral based. If you're referral based, there might be a great opportunity to buy the real estate because it's a little bit cheaper. It's not quite grade A, but you as an operator are getting a lot of your leads from maybe general practice or general dentists that are referring a lot of their business to you. So in those situations, you can save a little bit of money too.
Are you able to make development deals work today with land costs the cost of construction and interest rates?
Yeah, you can, absolutely. There's a little bit of financial engineering. It's interesting. I'll give a little bit of a long-winded answer, but 2020, I thought real estate was going to crash because of COVID. I was like, oh, let's sit on the sidelines and let's wait. Never crashed. In 2022, I thought real estate was going to crash because of the interest rate hikes. Let's sit on the sidelines. Let's wait for it to crash. Now, like, when is the crash coming? Especially in residential, especially in retail. Okay, you want to sector it off to specific asset classes. If we talk multifamily, if we talk office, yeah, a lot of office is suffering. Not all office, but a lot of office is suffering. Okay, a lot of multifamily is suffering. But one of the things is there's so much cash that's been printed over the past couple of years, and there's so much cash on the sidelines. Like no deal, if it's a hard asset that has commodities inside it, like no deal is going to drop so far that somebody isn't going to come in and buy it at a great cost basis, right? There are buyers waiting on the sidelines to come and scoop it up. But even in addition to that, the retail has been really strong. So especially grade A and B grade retail, it comes time to like trying to time this whole thing. It's just, it would take a lot to really derail it. I would have thought that in 2022, the cost of real estate would go down in direct proportion to the interest rate hikes, and it did not. And the reason is because think about it from a replacement cost. Replacement cost is extremely high. And so if the economy is strong and people aren't just losing their jobs, which unemployment is very low right now, then there's not really going to be a lot of businesses going under and creating vacant space. So what are you going to do? You have retail centers that have their tenants that are paying their rent. You have to build a new location. And if you're doing that, it's just going to cost a lot of money. Yeah, it's expensive. It's $57 a square foot for some of these tenants. But the real big tenants, like that I mentioned, Panda, Starbucks, Chipotle, Chick-fil-A, like they know the cost of real estate. They know the cost of doing business because it's that expensive, and they have to grow. They have to get their deals done. And yeah, it sucks because their rent costs go up, which causes their operational budgets to go up. But the alternative is not growing, and it'd be very difficult to time. I think at least I can't speak for everybody, but I assume that their thought is like, we can't time a market correction. Like we have to keep growing. We have to keep our shareholders happy. And so like the only option is just to pay the high rents. And the way that we do that is a little bit of financial engineering. So we utilize refinancing. If we're doing one project where our cost is like 4.5 million, so we're putting in 1.5, we're borrowing 3 approximately. These are round numbers. And when it's all said and done, it'll be worth close to 5.96 million. At that stage, we're refinancing based on the new appraised value to get a lot of the investment back into the investors' pockets. And that helps with the IRR because now our cost basis is lower. And then we'll collect annual cash flows, which will not be great after a refinance with high interest rates, but it'll be something. And then the goal is to, once we have the 5-year mark, the 5-year bump, because a lot of times rents bump every 5 years, then we refinance again. And the goal at that stage is to get 100% of the equity paid back to the investors. And then they will own but they're not out of the deal. They just simply have their principal back. They've collected cash flows up until this point, and now they maintain their equity interest in the building. So there's when you're providing value like this, yeah, interest rates make the deal less juicy. The monthly cash flows at the beginning are not great, but you can refinance, you can get a lot of your money back, and you're working with really strong tenants. They're not going to go anywhere. And then over time, you just have your principal paydowns, your debt reduction, and the equity, because the value of the building will continue to increase every time you have a rent bump. So it's like the get rich slow scheme, I like to say.
Absolutely. And you laid out the beauty of commercial real estate there perfectly. Because if you're looking for a cash flow or a home run on day one, this is not the business for you. But when you talked about your all-in cost for this hypothetical property, 4.5 million, and then when you're done and it's fully leased, you're close to 6 million. That's a pretty nice jump there. And then plus, if you're waiting 5 to 7 years, you've got 2 or 3% increases annually. Over time, that deal is going to work out. Austin, can you talk about, as you're going through these deals, that example that you just gave, there are a lot of pieces involved. There's working with the tenants, there's site selection, there's buying the land, entitlements, working with the GC and actually constructing the building. And then what do you do with it once it's built? So can you talk about your business, Leaders Real Estate? Are you doing everything? Or do you sell it off at the entitlement stage? Do you sell it off once it's fully leased? Where does your role start and end in this long development process?
So our role starts with the assignment from the tenant. So we're tenant driven, meaning we're developing relationships. So that's a big part of my job, is building relationships and trust of a $50, $100 million group. It takes a lot of time. It's a long sales pipeline.
So let me stop you there. Can you define assignment? So are you saying ABC dentist wants to expand and they say, yep, Austin, we want to build 3 locations in this general area. Is that what you're talking about?
Correct. Yeah. Yeah. They say, hey, we want to go to this specific trade area. And then we help them. We do our analysis. We help them either find a spot to lease, or if nothing's available to lease, then we'll develop a spot, right? If our analytics come back as, oh, this is a good spot, we're lacking some of these core tenants here. At that stage, we will they'll get the land under contract. We will have to fork out the due diligence cost and the down payment. So the thing about development that I've learned by getting my hands dirty is there is a lot of risk capital for every deal that you do. So the deals that actually work, they have to be home runs, because there's a lot of deals that don't pencil out that you just can't know. So you will have to put down a down payment, which maybe, sure, that's refundable. But when you start having to do environmental studies and impact studies and architectural designs to submit to the city to get their approval, like those, you're not getting that money back. And those can run into hundreds of thousands of dollars. So you really want to make sure that A, you have good, high confidence in this, but B, you're prepared to stomach a little bit of the losses and just have a big enough pipeline to where it spreads over that. So usually by the time developers are going to investors, they've done a lot of the dirty work, and they've got to where it's like a pretty secure, or there's approval, or they're about to close on the land, or they have a signed lease, something like that. So it's a lot safer by the time you might see somebody coming and knocking on your door asking for money. So yeah, for us, we are essentially in-house, like funding those due diligence, earnest money costs, and then like my partner and I, and then we do not do the physical construction ourselves. What we do is we have a group that we work with. We've done hundreds of deals together, and they're very fast and efficient, which is super important because time is money, especially when you have land under contract and you have high interest rates and carrying costs. What it'll look like is the tenant says, oh yeah, we want to go to this area. Nothing's available. Okay, this area is available to buy. Let's buy it. All right, now we got to start doing our due diligence, and we have to see, we might get it under contract, but now we have to see, is it viable? The city could require impact studies and environmental studies, which we had to pay for. And then when it looks like, and that's always a really fine dance, because it takes a long time. And a lot of times sellers don't understand that like the intended use for us is not what it's currently zoned for. And so they're like, why is this taking so long? Just come and buy it. And so there could be a situation, like just to use a random example, maybe it's zoned, you could do a car wash, right? We're using a retail dentist. Like they don't understand that there's a long formal process you have to go through with the city to get it entitled to do a retail center. So a lot of times there's a rub there. And then sometimes we have to end up closing on the land before we have signed leases or before it's even finished with the city, because maybe the city has expressed, yeah, this looks good, we will approve it, but it has to go through our council and it has to go through our committee, and the next meeting is not for a month. The seller's at this stage frustrated and about to back out of the deal. That's what the process looks like early on. And then, yeah, we're working with our general contractors who are nationwide that we, like I said, we've done a lot of deals with them. And and then in the background, negotiating the leases, signing the leases, making sure that they're covering the expenses with enough margin to make it worthwhile for us as developers and the investors.
What's your typical hold time period?
That depends on our investors. I don't know if your audience is familiar with the term LPs, like the limited partners.
Sure.
We have LPs that like to flip out of deals. So we've done some deals, like we did a deal where we were in it 18 months and we did 54% ROI, but annualized that would be about 37%. A lot of times they like to hold. And so the reason we like to hold for these deals is simply because when you flip out of a deal, you got to pay capital gains. And in our experience, it's been really hard to line up a 1031. So your listeners probably know 1031 exchange means you sell a deal, and if you buy a bigger, more expensive piece of property, you don't have to pay capital gains taxes. It's just hard to get like really good deals on 1031s when you're under that tight of a timeline, because these deals just take a long time to manifest. So we have not had success with that. We prefer to refinance it, which is not a taxable event. So you do owe interest on that. That's true. But you still maintain your equity in the building, which we think is a pretty big deal, because now you own an appreciating asset. You've taken out a lot of cash, which you don't owe taxes on. And as long as you have great credit tenants who have 10-year leases, you know that they're going to be servicing that debt for you. And so we think that like the trade-off of having a little bit less money from a refinance that we can reinvest as we see fit versus having a little bit more but owing taxes, and then not owning the asset after that, is a trade-off that's worthwhile.
You had mentioned in your process that you and your partner take on a lot of the entitlement risk before bringing investors on. I know that's a big risk in development, is entitlements and working with the city or county jurisdictions, and that kind of being an unknown and having a lot of unknown costs there. But it sounds like you and your partner take on that risk before bringing investors on. Would you, if limited partners are considering development deals, because sometimes the IRRs can look juicy on development deals, and that is partially because there is so much risk involved.
Yeah.
A lot of development operators want to bring on investors for that entitlement process. They want investors to pay for earnest money deposits for land and soil tests and environmental studies and traffic studies, and they're taking on a lot of risk. Would you caution limited partners when they're being asked to take on some risk in entitlements?
I think every bucket of risk has its correlated returns. So it's not that I would say yes or no. I would just say all dollars are not equal. Meaning, even for us, if we're raising money for a deal and we're going to use that money for the due diligence cost, they're going to be getting a higher return because the risks are higher, right? So, like, to use an easy example, sometimes you have these bridge lenders who they loan out money at 12% interest, and that would be the gap to fill the gap between what you can get financing for from a bank and then what you would normally raise the money for. So instead of raising money from investors, they'll say, hey, we'll loan you the 25-30% down payment and at 12%. Okay, that's your typical limited partner stake. For these same bridge lenders, if they're going to be doing the due diligence costs, then that number bumps up to 20% as an example. I think that, yeah, if you're going, there's nothing wrong with investing in the money early on, but the payout, like you should get a higher percentage of the profits for that risk factor.
Any other risks that potential limited partners or general partners and operators excited about development should be aware of if they're considering this kind of thing?
Biggest risk is just the tenant. It's really hard. CVS is closing several hundred stores right now. A lot of the retailers that we thought were like super safe are changing direction. So I think like getting to know the tenants that you're going to work with like as much as possible, because they're not even going to be transparent with you about as a developer or landlord as all the stuff, negative stuff that's going on behind the scenes. Why would they? They want to show a position of strength. So I would say that's the biggest risk, is just like knowing the tenant. And the reason that's like another reason to be cautious of that is because if you are, let's just say you get a great group, call it CVS, right? Like we just referenced, they're paying $65 or $60 a square foot. That's awesome. They signed a 10-year lease. In 10 years, they don't renew. But you built that build under like you ran your numbers based on a 60 square foot rent. And now all of a sudden it's a second generation space and nobody else wants to come and pay that much money. And so you're risking not being able to have that replacement cost. So that's the thing that I think you just need to be really careful about. And honestly, like we're throwing around big names like they're nothing. There's a lot of deals that are a lot smaller, just like mom and pop hair salons and fitness centers, right? Like I used to be in it, and that sort of thing. Like those are the ones that like franchisees, right? Like, McDonald's or Jersey Mike's or something like that. And you think, oh, great, but it's actually owned by a franchisee, and the lease is only it's only as strong as that individual franchisee. So those are just definitely risks that I would be considerate of.
What are your ideas to mitigate some of those risks in the long term with tenants?
That's why we just try and build the relationships with them and use a lot of the same groups over and over again. So like we're working with a dental group. They've got like 17 locations. We've done a handful of deals with them. Their financials are strong. They're growing pretty well. We've done a handful of deals with Starbucks. They're not going anywhere anytime soon. We know that they've recently switched their footprint to only having drive-through. So they closed down a bunch of stores that were like inline spaces because they couldn't do a drive-through. So they're switching their business model around. But as long as you have a drive-through space for them, you're safe. So yeah, it just comes down to due diligence and really knowing the team. And I don't know how to coach that necessarily, not off the top of my head, but that's like the important part, is if you can have a personal relationship with them so you can get the inside scoop as much as you can on the business and what they're planning.
Austin, this has been a great conversation. I've really enjoyed hearing from your perspective, your experience in developing these Medtail spaces. If listeners want to connect with you, where would you like to send people?
Yeah, I'm pretty active on LinkedIn. So my first name, Austin, like the city, hair like on your head. Check me out on LinkedIn, shoot me a message. And yeah, I'd love to connect.
Austin, thank you so much for joining me today.
Thank you.
Listeners, if you enjoyed this conversation, reach out to either one of us. We obviously love talking about commercial real estate. We would love to connect with you. Thank you so much for listening. We appreciate you. Until next time.